mandated the relevant committees to accelerate the completion of the design of that tool, and we've been discussing it at the Governing Council, so no final decisions yet as regards that.
Would you advocate for it to be like limitless and as a standing facility backstop without a duration?
Well, the characteristics would have to be usage if there is unwarranted fragmentation, which means that it is not based on the economic fundamentals, but then it has to be big enough and strong enough to be effective, but at the same time have within its design the ability to avoid any moral hazard issues.
It's a complicated task, so how do you want to conclude or come to a conclusion, especially given that you probably are well aware of the German Constitutional Court?
But there are tools in the past that have been successful in that respect, and we are well aware of the legal restrictions, let's say, and we will, of course, make sure that whatever the design of the tool is within the legal framework, for sure. But that has been achieved by the Governing Council in the past, and therefore I'm confident we can do that again with the design of the anti-fragmentation tool.
What is the timeline for setting that up? Would you also already announce something in July, or do we have to wait until the summer break?
We're working hard on it. We don't have a set timeline, but as I mentioned before, the PEP investment is already available, and that seemed to have the required calming effect as regards to the spreads. But as soon as there is agreement at the Governing Council, it will be announced.
Okay, let's talk about inflation. When do you see inflation peaking for the Eurozone?
We'll have peaking is this year, to answer your question. We'll have new data, of course, end of this week. But it's the most recent data shows peak this year, a decline next year, and coming very close to our 2% target the year after in 2024. That's why we started the normalization process.
I've been speaking to different central bankers from the ECB, and I think there are different ideas about how much the rates have to be hiked. So Pierre Wunsch is saying 200 basis points is a no-brainer. I think Robert Holzmann is going even further, saying the natural rate is 150 basis points and needs to be tighter. What is your view about the natural rate and how fast, how big the step should be?
I'm a proponent of gradualism and optionality. We need to first remember that we've been normalizing since December when we decided to stop PEP. Afterwards, we decided to stop the APP bond purchasing program on the 1st of July, and we gave forward guidance already on a rate hike in July and in September. Now, it's important to recognize how much uncertainty is out there because of the war in Ukraine and the surprises we get on the energy prices side. So I would rather we raise interest rates gradually. We announced a first rate hike of 25 basis points, see what the reaction is, and then proceed with the consequent rate hikes. So I wouldn't determine from now. We would see what the data shows along the way and then react accordingly.
Are you concerned about a recession in the euro area? Actually closing down the window, you actually can hike rates aggressively.
But that's exactly why gradualism is also warranted, because of the uncertainty. Of course, we are fixed on our price stability mandate of 2%, and we should do everything possible to achieve that. But being gradual and seeing what the impact of each rate hike is, and then deciding, that's also good for the economy itself, because you see the impact of each rate hike on the economy. And then you decide accordingly.
Let's talk a bit also about next year and what could happen then, because clearly for the US there's a risk of a recession. Could it be that the interest rate hiking cycle comes to a close by the end of this year?
For the Eurozone,
Yeah.
you mean? Currently, on the basis of the numbers we have, that doesn't seem to be the best case scenario. But that is why it's important to see what the impact of each rate hike is and then decide accordingly.
The markets have been quite volatile in recent weeks, with yields taking a lot. I think that yields are already showing you where rates might actually be at a certain point in time. Are you expecting yields for sovereign debt to rise further?
For specific sovereigns, or
Not just for the euro area as an aggregate?
But that's linking it to your previous question. Already, if we look at the STR rates, we have seen that the market has factored in an increase, which in effect is part of the monetary policy already taking effect, right? So our aim, or at least what I believe is a prudent approach, is that we give sufficient forward guidance to the markets in terms of our moves. Hence, we announced in June our intention for July and for September. And then when the time comes, we move according to the data that we have at each monetary policy meeting. And this is the kind of guidance that I think it's important to give to the markets, so that the yields do not move in an unwarranted way.
You've mentioned the Russian invasion in Ukraine. I'd like to ask you about the linkages between Russia and Cyprus, because I think the official perception is that there's a lot of Russian money on your island. So how are you dealing with that situation?
You use the word perception, and I think rightly so, because the numbers, and I can give you numbers in terms of the banking sector, show that there is no reliance or dependency or big Russian money in the banking system. Just to give you an indication of what the situation is, if we look at the total deposits of the Cyprus banking sector, only 4% of those show that there is a Russian UBO behind them. So that means looking at everything, including special purpose vehicles, and determining the origin. If we look at the asset side, total loans, those are less than 1%, it's actually 0.7% of total assets. 82% of deposits are local deposits, so it's from the locals, which shows that the dependency and reliance of the banking sector is on domestic long-term deposits.
Thank you.